Yesterday, it looked like a whole lot was going our way, but today that's not the case. What happened with today? Why did things change? Yesterday, we saw an unusual correlation occur towards the end of the day. That was that bond yields were falling despite being up in the morning, and then value cyclical stocks remained strong throughout the rest of the day, while tech stocks laid low. Today, we saw the opposite. Why did that happen? Well, when that bond yield fall happened yesterday, bond yields actually started the day up, but they fell based on a strong showing at a U.S. Treasury auction. There were a lot of foreign buyers trying to buy U.S. bonds. The U.S. is the strongest looking economy right now. Yesterday, there was a lot of talk about how cases had peaked. And yeah, foreign investors want to get in on that. So there's a lot of demand there. Today, we opened with bond yields down, and energy stocks tumbled pretty strongly. They did recover as the day went on, but tumbled pretty strongly in the morning. We then got a producer price index reading of prices up 7.8%, an all-time high rate of change. And the bond auction was weaker today. Bond yields peaked up. And energy stocks didn't really have a too strong of a move off that. They did start to recover and strengthen and stop the little bit of a tumble, but nothing noteworthy. Ultimately, how do we read this situation? Where's the thing going? Where's the market going? Let's get ahead of the game. The long-term trend is what I want to focus on. I don't really want to get it caught up in these day-to-day micro movements, these swings. We got to stick to the script here. We can't get caught up in the noise and the chatter. And the truth of the situation is that bond yields should tick up, and I predict that will occur. Why will that happen, and what will cause that? There are three forces being the primary drivers of a rise in bond yields. Countering to one force that can make them go lower, but can they even go lower is the question from these levels. Is it even possible to have bonds paying nothing? Well, it's happened, but it shouldn't happen, theoretically. The first force that is the counter to the one force that makes them go lower is the notion of an economic strengthening and a flight away from the flight to safety. Bonds are the flight to safety, so the force that makes them go lower, because bond yields go down when people buy them, is economic uncertainty. With Delta peaking and with the White House saying no signs of economic damage, with people kind of seeing that anecdotally, but just still feeling something in their stomach, as things start to roll over with Delta and we get back to the reopening trend, we can expect fears to alleviate and people to say, I can take a little bit more risk than this 1.5% yielding bond or thereabouts. And they will sell it and buy something else with a little bit more risk, maybe some energy in anticipation of an economic reopening. So that is one of the forces. The next force is inflation. We just talked about a 7.8% producer price index. We had a 4.something, I believe 4.2 or 4.8% consumer price index reading yesterday. Those are high numbers, a lot higher than 1 and change, which is what the up to the 30-year had been paying until today. The 30-year broke 2% today for like the first time in a long time. Still about half the rate of inflation, that 2%. So that rate technically should be above the rate of inflation, the rate the bonds pay, because otherwise you're getting a negative real yield. You're giving up buying power and getting less buying power in the future. That's the way that's working right now. Theoretically shouldn't happen, but is happening. Unusual, probably will correct in the long run the time frame that we're playing in. The third and final force that is coming that will lead to a rise in bond yields is the Fed taper. The Fed has been an artificial buyer in these markets, buying at least $120 billion of federal treasuries each month. It's really been more like $160 billion, and it's been going up, and it's been going on since March of last year. It's a long time, a lot of money, well over $1 trillion of artificial purchases. That will likely subside in the coming few months. So, we got forces working and likely to make bonds tick up. And we know value stocks and energy stocks are highly correlated with bonds in the notion that if bond yields rise, value stocks rise. So, we are staying long the trade. We're not getting caught up in these day-to-day movements. We're staying long, we're staying steady, we're focusing on the long term, and hopefully we will reap the rewards at the end of the day, or the end of the quarter, or the end of the year. That's the time frame we're thinking. So until next time, peace out.